Previously, we mentioned about the analysis of the cash inflow and the cash outflow. We talk about the differences between the characteristics as well as the computations of the cash inflow and the cash outflow with reference to the work progress, payment schedules, as well as the bills of quantities. To strengthen your understanding, let us have a quick glance in terms of the differences between the cash inflow and the cash outflow. The cash inflow refers to the payments received from the purchaser. As for the cash outflow, it will be the payments to the supplier for the acquisitions of the raw materials, machineries, and other resources in order to support the project activities. You receive money from the purchasers. That means the money is going into your company's account. You pay for the materials. That means the money is going out from your company's account. That's the meaning of cash inflow and the cash outflow. Now the next question it will be, how do you estimate the amount of money going in and going out of your company's account? You will estimate the cash inflow on basis of the payment schedule. The payment schedule is normally attached together with the sales and purchase agreement as agreed between the developer and the buyer that certain quantums of the payment shall be made as the developer has completed certain stages of the project. As for the cash outflow, the estimated amount shall be based on the bills of quantities. By referring to the bills of quantities, there are discrete items where the quantities are specified. The rate and the amount shall be confirmed in the contract document. You may refer to the details in the bills of quantities together with the project schedule for you to compute the cash outflow. Please bear in mind that the computations of the cash outflow shall not base on the payment schedules, as there may be deviations between the quantum specified in the payment schedule and the actual expenses for the project work. Now, in terms of the calculations for the cash inflow, it will be on basis of the sales forecast. The calculation shall be based on individual units. When they are sold, only those units that are sold shall have the progress payment upon completions of the project stages. Therefore, the calculations of the cash inflow shall be based on individual units with reference to the sales forecast. As for the calculations of the cash outflow, it is calculated by unit groups based on the project schedule. If the project is carried out in one single phase, that means you will have to group the expenses for all the units of the project together while computing the cash outflow. If your project is carried out in several phases, then the computations of the cash flow can be discrete into various phases. A good comparison between the computations of the cash inflow and the cash outflow. Let's say we are talking about one single phase. Your expenses, it will be on basis of all the units. Whereas your cash inflow, it may not be all the units. It is only associated to those units being sold. You would not receive any cash inflow for the units that yet to be sold. Because of these reasons, most likely you will expect that there will be negative cash flow at the early stage of the development project because you are spending more than what you are receiving. Next, we talk about the lagging and the leading characteristics of the cash inflow and the cash outflow. Taking into considerations the durations required for the administration's processes, such as issuance of the interim certificate, as well as the period of honoring certificate, you will expect a slight delay in terms of the cash inflow as compared to your actual work progress. This is the lagging characteristics of the cash inflow. As for the cash outflow, you will need to prepare all the raw materials, machineries and other resources upfront so that you can use them during the project activities. Upon acquisitions of those materials, you will need to pay to the suppliers. That leads to the leading characteristics of the cash outflow. This again will require you to have sufficient capital to finance the project activities in order to ensure the project is running smoothly. You need to pay first before you get money from the buyer. Next, we talk about the cost that you estimated for the cash inflow and the cash outflow. You know that the estimated amount for the cash inflow shall be based on the payment schedule. The payment schedule is computed on basis of the selling price. That means the selling price shall cover your construction costs plus the profit that you gain out of the development project. Now the estimated amount here, which is obtained from the payment schedule, it will be inclusive of the profit. On the other hand, when you are computing the cash outflow, the estimated amount, it will be based on the bills of quantities. The bills of quantities is what you quote to the employer regarding how much you're going to charge once the respective works is completed. Now, whatever amount reflected in the bills of quantities, it is also inclusive of the profit. That means the estimated amount here, it will be the construction cost plus the profit. However, when you talk about the actual cash outflow, it will be purely the construction cost. The profit is not a part of the expenses. This leads to a slight deviations between the estimated amount for your cash outflow and the actual spending for your project. The cash outflow is potentially overestimated, subjected to the degree of the profit margin. Knowing about this, if you wish to have a very accurate estimations of the cash outflow, the estimations based on the bills of quantities will have to be deducted with your estimated profit margin so that it more closely reflects the actual expenses for your project. Now the next question it will be, do you really need to do that? Of course, it will be more accurately reflect the actual spending of the project. Now the question it will be, how confident are you that you have taken into account all the necessary expenses associated to that particular work? There may be some hidden costs that you might overlook, which if you totally remove the profit margins, you might underestimate the amount of cash outflow, which subsequently may lead to underestimations of the potential risks of your project. Therefore, personally, I will go for a more conservative estimations, where the estimated amount shall be based on the bills of quantities, knowing that it is potentially overestimated because of the profit margin. Later, when I compute the net cash flow, because of slightly larger cash outflow, when I calculate the total capitals that I need to prepare, then I have an idea. The chances that I'm not preparing sufficient capitals to finance the project. Having this understood, we can now look into the limitations of our analysis for the cash inflow and the cash outflow. First and foremost, our calculations of the cash outflow, it will be based on the bills of quantities. you know that the amount for the bills of quantity shall inclusive of the construction cost plus the profit. Therefore, you know that you may have overestimated the actual cash outflow. For conservative estimations, this is acceptable. Sometimes we are not confident enough to have included all the hidden costs associated to the project activities. Therefore, we use this slight overestimated amount to cover those expenses. Next, in our computations of the cash outflow, the corporate tax is not being included. You know that corporate tax shall be paid annually. If you wish to have a more accurate estimations, particularly when you want to compute your net cash flow for you to determine the capital investment that you need to have, as well as the final profit that you have acquired after tax, for you to compute the return of investment, probably you can consider the corporate tax. Bear in mind that the corporate tax shall be charged based on the chargeable income. That means on basis of the profit of your company. Not all the expenses shall be chargeable for the corporate tax. There are deductible expenses and non-deductible expenses. Now, your company revenue can be minus the deductible expenses and minus the tax relief. Based on the paid-up capitals, the tax rates are given here. This is for typical corporate. For your informations, there are tax incentives for SME. SME stands for small and medium enterprise, where the company income will be less than 2.5 million per year. Now you will need to check your project against this number to see if your company is eligible for the tax incentive. This is a government policy to encourage the small and medium enterprise to compete in the market. For a company less than 5 years old, there will be tax exemptions. As for company more than 5 years old, there will be tax rate 20% for the first 500,000 and 25% for the subsequent. Now, in the context of the integrated design project, if you choose to consider the corporate tax in your analysis, you might need to check your contract sum as compared to your work schedule, specifically the durations of the project. Let's say the project takes about 2 years. You're going to expect your company income shall be equals to the contract sum divided by 2 years. Then you check whether your company is qualified for the tax incentive. You might need to also make assumptions in terms of the age of your company, whether you are qualified for the tax exemptions or you are chargeable for the tax. Or you can use the standard corporate tax structures for you to do the estimations. Now, if you find the calculations of the corporate tax is too complicated, you can simply assume a number with respect to the quantum of your net profit. The amount should be more or less there. Next is about the accuracy of the analysis that you use to calculate the cash inflow, outflow, and the net cash flow. The accuracy will be very much reliant on your sales forecast as well as the project schedules. If the sales forecast and the project schedules closely reflect the reality, then your analysis shall be quite accurate. Now, if the sales forecast or the project schedules are beyond realistic, whatever result that you have obtained from the cash inflow, outflow, and the net cash flow analysis, you know that those will end up with just numbers. their roles and functions in making good business decisions shall be quite limited.